We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve Van Metre, financial planner, portfolio manager, and the self-proclaimed bond king. Thanks for joining me today, Steve.
Tom, thanks for having me back on your show.
Well, it's excellent to have you back. And, you know, we had an interesting discussion last time, and you have some maybe cautious advice, maybe not what everybody wants to hear, but I hope that everybody can take it for the well thought out viewpoint that it is. Again, might not be the most popular, but I encourage our listeners to be respectful and, tell us why they think Steve may or not be right or wrong. And again, it's great to have the bond king back. So I want to start by asking you, kind of thinking about what you got right and what you got wrong from our last conversation. I know when we spoke last, a good example of something that has really changed is we've seen savings rates actually grow. So maybe give us a little bit about kind of what you've seen change since then.
Well, if you want to look at calls that I got wrong, I mean, that's easy. Any macro guy will be wrong. And it comes back to time frame. And I think a lot of people, they're easy to point out, okay, well, Steve, you're totally wrong. Bonds have gone down from August. Okay, you're right. They have. But what if my entry point was 4 years ago or 2 years ago? And that's the thing I think people don't really grasp is it's easy to point out where someone's wrong. I mean, and I could do that too. We could just sit there and turn the laws wrong here, and here. But in a macro thesis, I look at mine 3 to 5 years in length. So for me to say, yeah, all right, I was wrong about August. Well, it is what it is, because in the end, my whole thesis is going to play out as interest rates collapse to zero. Now, what I was right about, that a lot of people I think are probably shocked about, was my call on GDX and saying, hey, GDX is going to head lower. Mm-hmm. And I know that's a very unpopular opinion. In fact, as someone who was never the cool kid in school and is probably not a very cool macro guy on top of that, it's okay, because one thing I look at is a relationship between TLT and GDX. And if for those of you watching or listening who don't know, TLT is a 20+ maturity treasury bond fund. GDX, I'm sure most of your fans know, is a large gold mining fund. And I always encourage people, when I hear someone who is really bullish on miners or gold and says, I also think interest rates are going to go up. And my answer is, have you ever charted the two against each other? And the answer usually is no. And I always encourage people, hey, go run GDX against TLT. And I usually get a response of, wow, I had no idea. Mm-hmm. And what's interesting to me is if you're bullish on gold miners, then you really should be bullish on bonds. And it doesn't make a lot of sense, because you would normally assume, hey, interest rates are rising. That means inflation and lower bond prices. So that should mean higher precious metals. But if you look at a chart, you go like, wow, that's not what I expected at all. So yeah, I was wrong about bonds since August, and I'm okay with it from a macro perspective. But what that's done is it's pulled GDX down with it. And really what I'm looking for is a flip between the two. So what I want to see is bond prices rising and GDX continue to fall, or miners or broadly or metals continue to fall, because that's telling me that liquidity is drying up in the markets. And if that happens, that's going to pull the broad equity market lower and give us another event such as we saw in March, or you can even go back to like October of 2008, which is really interesting, because you see TLT and GDX follow each other along, and then there's a time where they completely flip, and it usually is TLT leading, rising, and GDX falling, and it tells you major risk off event is coming. So when I look at GDX right now, do I think, okay, yeah, so I was wrong about TLT since August, but I'm still set up for a major move higher in it, because it doesn't go down as much as, say, the miners do. So I think we all know, anyone who's invested in miners know they move quite a bit relative to other pieces in the market. So if you look at GDX, you've seen, from a number of technical things, you've got a nice head and shoulders pattern, a very big one on the 1 year chart. It crossed its 50-day moving average and has been trending below it, which is another thing I like to look at. Momentum has been declining. So I look at GDX and say, all right, this thing's sitting, 34-ish right now, 35. To me, you've got this beautiful pattern that breaks down at 31, potentially since GDX back to 16 to 17, which is kind of my original call for when I was on your show the first time is, look, if I'm wholly off on bonds, which could be highly possible, what's my exit point? Well, what if I could buy GDX again at 16 or 17? And a lot of people are like, man, I'd love to. Not only do I think they're going to get a chance, I think if you see GDX pull down that far, the rest of the market crumbles with it, wouldn't shock me. Wouldn't shock me, Tom, if we see a 12 print on GDX. And at that point, if GDX is sitting down that low, I can tell you the bond prices are going to be through the roof. That's the big move I'm looking for from a macro perspective, because I know we're in a world with zero trade fee where people are constantly churning their accounts. And this notion that, man, you invest in something for 3 to 5 years, like it seems foreign to a lot of people anymore. But that's the play. I'm looking for a big move higher in bonds, cash that out, and then flip over into the inflation sensitive mining sector at what I perceive is going to be the last big generational, and maybe my generational opportunity to buy it at such a cheap price.
Interesting. So is the, let's say, relationship to GDX falling to, the let's say anywhere from $12 to $16 level, that is because of a liquidity event, as you're saying?
Yeah, so liquidity starts to dry up, and it's kind of interesting if you look at then GDX to say the broad equity market, say the S&P 500, you'll see that when mining stocks start to get weak, it doesn't always mean, but it's a precursor to major liquidity events. So if I see this head and shoulders top complete, which I expect it will, get down to 31 and then break through the neckline, at least that's where I've got it drawn. I know there's an angled neckline you could draw there too that would suggest that it's going to break around, let's see, 33-ish. That, yeah, it's a proxy for broad market liquidity. And when it breaks down, it tells you the broad equity market's going down. And with all the speculation that's sitting in the equity market, which to me is just, I think it's the worst in terms of how many people are just gambling on the broad equity market, that if that breaks down, I don't mean to suggest that GDX going to 12 is a positive for it. I just think it's just going to get shoved down there as all the speculation unwinds, which again, to me, is going to be the huge opportunity. Because I know you have people that are listening to shows that, man, I wish I could have bought it back when it was 12. Well, I think you might get a shot at that again, because the technical support is 16 to 17. If it doesn't hold, there's a lot of dead air below that.
Interesting. So talking about liquidity, Steve, why is the Fed stuck in a liquidity trap, and how has it created this? Is there too much liquidity right now?
Yeah, there's way too much liquidity. And so I think if we don't mind, Tom, let's go back a little bit and kind of set the stage of how we got here, sure, if we could do that. And so a lot of people are looking at the broad money supply. Back in March of last year, the money supply started just running up at somewhere 25, 20%, 27% on a year-over-year basis. And what was the big thing we all heard? Inflation, right? This has got to be it, because the money supply is rising. And a lot of people don't even know what that means. They just know what's going up. So let's define what the money supply is. It's checkable deposits, savings deposits, and your money market mutual funds. And if you don't know what that is, think of that the money market option in your 401ks, IRAs, and things like that in your brokerage accounts. That's what the money supply is. So all this telling you is money is ending up mostly in people's checking accounts, savings accounts, and in their brokerage accounts. Okay, so where did it come from? Now, the view is that it came from stimulus. But the stimulus wasn't passed. It got passed at the end of March. The checks didn't go out in March. So where did this big rise in the money supply come from? Well, it came from corporations who realized, which is pretty wise, that, hey, during the great financial crisis, we bought into this whole Fed was going to save everything. And that was a dumb idea. Like, that didn't work at all. So they were pretty smart. They immediately ran out and pulled their credit revolvers. Now, if someone listening says, I don't know what a credit revolver is. Well, if you've ever had a home equity loan, a line of credit, That's an equity revolver. So, maybe you've got it sitting there right now in your house, and maybe you don't have a loan on it, but you've got, say, 100,000 you could go tap. Well, that's what these corporations did. They ran to the banks and said, we want that 100 grand, which was actually obviously a lot more than 100 grand when you aggregate how big these credit lines were. And they stuck it in their checking accounts because they didn't want to trust the system this time, because they got effectively screwed the last time. And all of a sudden you see this huge surge in the money supply, which then, of course, we get the checks coming out in April of 2020, the stimulus checks. And now there's this perception that Tom, you and I are just piled full of cash. I mean, our bank accounts are so full, of money that are, like a bird, our gullet is full, and we just need to go out there and spend it. But that's not entirely the case. There are people in the population that do have, excess money in their bank accounts. It's not the majority. What you're seeing mostly in the money supply is all this corporate borrowed money, and they're just sitting on it because, again, they don't know how this is going to end, and they don't trust it. So what did they do then? They went out and they, some companies issued new stock. A lot of companies issued bonds, and that doesn't go into the M2. So all that money that they borrowed was just sitting there, and it got repaid back. And so everyone got really excited and now thinks that, hey, look at all this money sitting in bank accounts. There's all this pent up demand. It's got to come out. It's going to be massively inflationary. But yet, Tom, here we are on CPI day of all days. We get a print of 1.37, rounded up 1.4 for January. And we're 1 month away from this major March event of last year where the money supply rose, and we're in a disinflationary trend. And so it's got a lot of people kind of scratching their heads going, but it's got to be inflationary. And so, one thing I kind of push back and say, well, when's it going to be? Is there a 12-month lag on the money supply growth and then inflation? Is there an 18-month supply? Or there's a simple way, chart the CPI versus the money supply. And you see there's not a lot of relationship there. So this isn't going to transpire into a lot of inflation. Okay, so the question then becomes, well, then why aren't we getting inflation? It seems so obvious, right? I mean, there's all this money sitting in accounts. It's got to come out. It's got to be inflationary. Why aren't we getting it?
It's more related to monetary velocity, right?
Well, that is one factor, is money's not moving, but there's a bigger factor of how we got caught in this liquidity trap. And this is something a lot of people don't even know is possible, which kind of dovetails into we're in a liquidity trap with too much liquidity, which is, it's like saying that you have too many beers and you're at a party, right? It's like, that doesn't make any sense, right? So how did we get in this liquidity trap? Well, it's created by the Fed. So when you have a rise in the money supply, you would naturally think, okay, that is inflationary. The offsetting problem is, what if there's an equal rise in the demand for money? And that's what we can't intuitively see. We can't just go and chart and say, oh, there's this rise in money demand. We can't see it easily. We can see it through the monetary base. So when you have an equal rise in the money supply and the demand for money, inflation stays flat. So if you look at the CPI right now, it's been trending right around 1.4-ish for the last several months. And what does that tell you? That the growth in money demand is equal to the money supply. Now, if you look at the actual formula, which is you take the M2 money stock and divide it by the monetary base, which creates this nice ratio we call the money multiplier, it's been trending lower. And what that tells you is the demand for money is actually growing faster than the money supply. So what happens then? Well, that pushes prices down. So it creates a disinflationary pulse. And if you get enough demand for money, or you get the money supply where its growth is flattening out, then you can get outright deflation. So it's kind of interesting because you look at the money supply last month, due to the stimulus checks, it grew around 440 billion, but that was 1 week out of the month. The rest has been flat. So what it's telling you is there's this heavy weight that's caused by this liquidity trap from the Fed. Now, someone listening is going to go like, okay, well, I still doesn't make any sense. How is there demand for money when there's money sitting there? Well, that's a great question. So if you look at, a saver, so let's just say that, we've been saving money and, we all as a family have a certain amount that we want liquid in our savings account for emergencies, right, Tom? I mean, there's a certain amount that it just sits there doing nothing, but we all say, if there's an emergency, at least I've got that, right? Mm-hmm. So what happens when you exceed that number? Well, you look to reinvest that in a higher return. So, CDs, right? Very popular way for, many households to earn a little bit of extra interest on their little bit of extra savings. But CD rates are marginally higher than cash rates. So why would I go tie my money up, say, in a 5-year CD if I'm making almost nothing more than just keeping it where it's at? And then you start looking out the curve and say, well, what if I went out, at different intervals, and you find out that interest rates aren't that high? Mm-hmm. So the demand for cash comes from not only quantitative easing, which has a high demand for cash, but it comes from the fact that consumers have nothing else better to do with their money. And to illustrate that point very easily, if anyone's still, kind of struggling to understand this, if Treasury rates were at 8%, we wouldn't have a demand for cash problem, because what would happen is people would go out and put their money in longer term issuance. So they look for corporate bonds and government bonds and other avenues, and you'd see that money going out of the money supply into debt. So when you have low rates, which are which have been compressed by the fact that quantitative easing lowers interest rates, it takes away where consumers can invest their money. So you get this what's referred to as a demand for money. Mm-hmm. So oddly enough, anything that creates money going into a consumer's pocket, such as say a stimulus check, oddly enough, now you wouldn't think this, right? Because you think, okay, stimulus, Steve, Tom, they're going to get the checks, go out and spend their money. It actually creates more money demand, because when we put it in our bank accounts and do nothing with it, well, that creates money demand, and it's all part of the big picture. So what you're seeing right now is money demand is actually outpacing the growth of the money supply, which is disinflationary. Now, we haven't seen the CPI roll down from that yet, but it tends to follow where the money multiplier goes.
Interesting. So how does the Fed then, spark this inflation that they're so-called targeting?
Well, by doing the exact opposite of what they're doing. Then that's, I remember when I was first trying to figure all this out years ago, and I really wanted to understand how quantitative easing worked, because everyone said quantitative easing does these certain things, has these certain effects. And I would just look at the markets and the charts, and I'm like, that's not adding up. In fact, it looks opposite. So when I really got into how the quantitative easing worked and what it does of suppressing interest rates, I remember one day coming to the conclusion is, if we really wanted to hit the Fed's target, we would need to do the exact opposite of what we're doing, mm-hmm. which would mean raise the federal funds rate and unwind the balance sheet. Now, if that sounds perplexing, well, come back to what we just talked about. If interest rates went up, people would then reinvest their money elsewhere. Mm-hmm. Well, that's exactly it. If the Fed flooded the economy with the bonds off their balance sheet, it would drive interest rates up, and then investors in consumers and businesses that were sitting on cash would go chase it. Mm-hmm. And then you get inflation. The other way you can do that, now that you understand the relationship between money demand and the money supply, is you need to raise the money supply a lot faster than money demand. Well, how do you do that? Well, you could get people to sell their stocks and park it in cash. You could get more stimulus checks. It's just really hard to do, because the fact is quantitative easing in itself creates this high demand for money. It's evident in Japan. I mean, that's why they struggle with it. We're doing the same thing they're doing. And so as a result, you now have the secondary problem that you kind of mentioned earlier of maybe we have too much liquidity. Like, how does that happen? Well, when a bank gets a deposit, that is a liability to them. It's not their money. Right, it's mine, and at any time, if I have money deposited in the bank, I can access it, and they have to be prepared to give it to me and anyone else. Right, if you and I go to the bank same day, Tom, they have to give it to both of us and everyone else. So the other problem is they have to pay interest on it, right? Because we expect that as customers of the bank. We don't pay to have our money there. We feel we should earn some interest as a privilege of letting the bank have our money, right? So how does a bank match that liability? Well, they need an asset. And not only do they need an asset, they need an asset that if enough people came into the bank and pulled their money out, they could turn that asset back. to cash. They need T-bills. They need a ton of T-bills, and T-bills are 12-month and shorter maturity bonds. In fact, if you look at what banks own, about 75% of the banks, in terms of their treasury holdings, will be 3-year, 2-year, and then all the rest is all T-bills. So they need this, and they need it badly. And so you see in the auctions all of a sudden over the last couple of months that these T-bill auctions, I mean, banks are effectively bidding at 0% interest on these things. In fact, the last 2 weeks you can look and I mean, they're pretty much willing to pay any price to get them, because not only is there a ton of money coming in, there's a ton of more money coming, because we know there's probably going to be another stimulus check. The economy is getting weaker. Unemployment rate over the last 4 weeks is average, new claims by about 850,000. So when people don't feel confident on the economy, they don't spend. At least generally, that's kind of how it works. They start saving money because they're uncertain. What am I going to have my job back? How am I going to take care of all these things? Well, that puts pressure on the banks, and they need to get high quality liquid assets, or T-bills in very short-term notes. Well, so what's the problem? Well, the Treasury just announced under the new head of Janet Yellen that they have to bring down the Treasury General account balance, which is the checking account of the government, because it runs into some issues when there is a budget that comes up. So this summer, so they have to bring it down to normal levels from 1.6 trillion to about 300 to 400 billion. Now, of course, they're hoping the stimulus package will do a lot of that effort for them. But one of the ways she has, in her infinite wisdom, which I find odd as a former Fed chair, and someone who has a strong relationship with banks, she is going to do this by issuing fewer T-bills. Now you think, right, if the banks are struggling with liquidity issue in terms of they have too much, right, and they need more T-bills, that one of the solutions would be, hey, Treasury, can you go out and issue more T-bills and cut your other issuance? The secondary problem to this, if you look at what the Fed's doing now, the Fed's not buying T-bills right now. They learned that lesson in March of last year when they caused a liquidity crisis then, is the Fed's buying a majority of all of the issuance of the 2 and 3 years that go to the primary dealers. So at auction, there's 3 major bidders. You have the primary dealers, you've got domestic bidders and foreign bidders. Well, the primary dealer banks are the ones that are flipping all of their bonds to the Fed. Well, if you look at the Fed purchases, they're buying almost every 2 and 3 year note that the dealers are getting, so that's then telling the banks, like, look, we're giving you less cheap, you're not getting the notes you need, you're not getting the bills you need. And so what that's doing is it's putting a massive demand and driving the short end of this curve down. The risk is you see it go negative. Then you've got a real problem. So here we got a liquidity trap on top of too much liquidity, and the two organizations, right, the Fed and the Treasury, that have the ability to fix this problem, right? The Fed could say, we're going to stop buying 2 and 3 year notes. We're going to go out the long end of the curve. The Treasury could say, look, we're going to cut our issuance of 5, 7, 10, 20, and 30 years and issue a boatload more T-bills. They're not doing that either. And so here we're at this risk where we can see the short end of the curve go negative because we have too much liquidity, of all things.
Crazy. So as you were mentioning interest rates, Steve, if the Fed were to try and push interest rates up to spark this inflation that they're targeting, doesn't that put them in a hard place as well? Because to be able to service their debt, that creates more of a more demand or whatever to really service that debt, right?
Well, okay, so you're referring from the government level. The government never has a problem servicing its debt. It can just raise the debt ceiling. I mean, it's a game that Congress plays about it, and they act like it's a big deal. But in the end of the day, it's just if you and I are on opposite end of the political fence, it's how you and I negotiate to get the stuff we want over this level that we know we're going to raise anyways. So it's just a big game. The bigger problem that I would see is not at a government level being able to service the debt, is we're already seeing a deceleration and in some sectors a contraction in credit. And this is something on my show that I cover each week under what's called the H.8. So if we raise interest rates, then what do consumers normally do? Do they borrow more or less? They usually borrow less. Mm-hmm. So when you're already seeing a deceleration and a partial contraction in some, like I said, in some sectors, and then probably by the end of March, we'll see an outright contraction. in total loans and leases, which is only running on about a 2 or 3% year-over-year basis now. If you raise rates, you get a credit contraction. Well, that's what happened in the great financial crisis, is credit contracted. Now, if someone listening says, I don't understand why that's really that bad. Well, then you come back to, how is money created and destroyed? Well, money is destroyed when people make a principal payment on a loan, whether it's part of a regular monthly payment or a one-time payment. Anytime there's principal payment, money is destroyed. Well, in a debt-based economy such as ours, you need a constant creation of debt, and even more debt. And then after that, even more. Well, if you raise interest rates and credits are contracting, that starts to chew away at money. Well, that puts now downward pressure on the M2 money supply. Now, it doesn't necessarily mean it's going to contract it or cause a big crash in it. It just means it's going to put downward pressure on it. And if the Fed is still doing QE, creating demand for money, then you get more disinflation and potential deflation. So the problem is, the Fed really can't do that. They can't raise rates to create inflation, because they're going to, well, let's put it this way, Tom. If they were willing to do that, they would first have to accept that they're going to crash the economy, and then they would get what they want. Mm-hmm. You can't get both. You can't, raise rates and get an economic recovery. If you're going to raise rates, you'll get your inflation, but only after the economy crashes. If they're willing to do that, they can get it. Otherwise, they'll continue to suppress interest rates and inadvertently crash the economy.
Perfect. Yeah, that's something I just wanted to kind of get your perspective on, because you talk a lot about relationships on your show. So I want to go back to a little bit about bonds here. So when that tide in bonds shifts, you were saying that anybody that is short is doomed, because the CTAs will start to jump back in. So what does this short position look like in bonds, and is it comparable to a GME or the silver situation that we've been hearing so much about lately?
Yeah, it's really interesting in the sense there is a lot of similarities in terms of how the GME shorts got flushed out and the silver shorts got flushed, and whatever other shorts that are being targeted. I'm sure there's some being targeted tonight, for all we know. But exactly. So what happened in August is you had the largest short selling of not only just selling the bonds, but speculative short selling against the long bond in the history of the long bond, which has been around 43 and a half, almost 44 years. So you have more people selling or shorting the long bond than ever. And there's a couple big players in here. So you have the CTAs, or what are called Commodity Trading Association, or quant computer models. They're what I like to call agnostic machines, because they don't read the economic data like some of the, what we call algos, right? That you see, okay, the news hit and all of a sudden, boom, something somewhere is moving up and down faster than you can even blink. These machines are traded based on price level. So they have a formula that says if price is rising and based on some certain metrics, we buy. The price is falling, we sell. Well, in August of last year, they hit their sell triggers. Now, this is not data that you can get readily. It's not publicly available. Every once in a while, it'll show up either on a podcast or a news site from somebody that has intimate knowledge of these machines. And they are massive sellers. I mean, I don't know what their footprint is of how big they own, but the last time they went on a selling spree was August 19 through January 2020. It took them 6 months. So imagine, Tom, that you have so much money invested, right? That if you want to exit your one position, it's going to take you 6 months to do. I mean, that's just inconceivable about how much money these machines control. Well, on top of that, you had hedge funds in the futures market. They were shorting the long bond at, they went to a 4 standard deviation short, and maybe after last week, they'll be back to it. I mean, they're probably around 3.5 standard deviation short. You've had retail investors selling like crazy, institutional money managers selling, pension funds net short. Effectively, everybody says, I don't want to own a long bond. In fact, I want to bet against the long bond. And if you're wondering why, well, this is a pretty simple reason. If you really believe the Fed is printing money, and you believe that this is going to create massive inflation, the layup trade is to short the long bond. Mm-hmm. Now, if you know how the system works and you know it's not going to happen, then the layup trade becomes owning the long bond, because you just sit there and collect your interest until everyone's wrong and they go fleeing out. So if you look at what's happened now, and I don't know if we just saw the bottom in the bond market here the last few days. I think we probably have, because you look at the selling pressure is abated. The CTAs are done. The speculators are heavy short. The retail investors are pretty much long gone. and nobody wants to own it. So what happens is when you're short, as we've seen in GME and silver, is as prices rise, and if someone's like, well, how is that going to happen? The Fed's buying. The Fed's buying a lot of these things. In fact, if you look specifically at the 30-year, the Fed's buying $10.5 billion of 30-year bonds a month. The dealers at auction are getting around $5 to $5.5 billion of new issuance per month. In some cases, less. So that means the dealers have to go out to the broad open market and source at least $5 billion. Some months more, seven. Like last month, they had to get $7 billion out of the market to feed the Fed. I mean, so just think of this as just this animal that just won't stop, just constantly eating. Mm-hmm. Well, so if the Fed's buying bonds, forcing dealers to go on the open market of buying bonds, then that's going to put upward pressure on prices when all the people are selling are done. In fact, given the fact that there's a record amount of selling since August, interest rates haven't gone up that much. I mean, as much as they probably could have. Mm-hmm. So what's going to happen is the Fed is going to orchestrate the short squeeze unintentionally. They don't know they're going to do it, but they're going to do it. And the fact that the short end of the curve is just pegging at zero and likely potentially even going negative will force people on the short end of the curve to go down the curve. That all these people that are short are going to get massively squeezed out. And then at some point, you'll reach a trigger point where the CTAs buy back in. Now, what's interesting, if you go back to January, mid-ish January last year and look at a price chart of, say, the long bond or TLT, you'll see it just went straight up because the CTAs are really interesting machines. When they sell, they're very methodical. They do what's called sell the rip. So anytime prices go up, they'll sell it down. Then prices go up, they sell it down. When it comes to buying back in, they're like panic. Like, oh, our price is going up. Well, what's weird is they chase their own price up. I mean, again, back to, I have so much money to invest that when I buy, it triggers my next buy signal, which triggers my next buy signal and so on. Well, between early January and March, they went from neutral to 100% long. They were the ones that drove prices up. And at the same time they were driving prices up, hedge funds were busy shorting them. So now imagine this. So here's kind of an interesting how this plays out. Everybody thinks reflation's coming. The short end of the curve says, no, we've got too much liquidity, potentially going negative. The long end the yields start to go down, prices start to go up. All of these shorts start to get squeezed. And then we trigger the CTAs buying back in, which isn't far off, like 4 or 5% from current levels, at least based on the last known data that I've got. So they start buying in. If yields on the long end start collapsing, what is that going to tell us is going on in the economy? It's going to say major risk off event. It's going to say, it's not going to say reflation. It's not going to say inflation. It's going to say, oh my God, things are so bad that the long end of the curve is collapsing. And it's, again, due to a price agnostic buy. It's not based on anything real. And then, so all of a sudden you have this massive buying pressure that will kick in on the long end. The hedge funds are then going to realize, we're on the total wrong end of the curve. They're going to go running out of their positions. The major pension funds that have been shorting this are going to have to come back in and buy. And retail will eventually chase. Everyone will come back in and drive yields on the long end back to zero. That's what I think how this thing plays out. And if that happens, talk about a liquidity vortex in the market because everyone's leveraged long. So now if they're short one end, right, as we saw, with some of these hedge funds blowing up, is why did they blow up? Is because they were so heavily leveraged on their position to get out of it, they got margin called on their other stuff. Well, that means they had to force sell. Well, imagine if you have this massive move in the bond market and everyone who's short or who is short the bond market is also short the VIX or volatility, and long the equity market. They got to sell their equities, right, to cover their bond positions that they're getting annihilated on, which causes vol to rise, right? So now they've got to sell more equities to cover their vol shorts. Now the bonds keep going up. Next thing you know, the whole system just runs into a crunch and interest rates collapse across the curve. Bond prices spike, liquidity gets pulled out of the market in a way we've probably never seen before. And if that happens, I look really smart, and you'll have me back on your show.
So, as you like to say a lot, that's the head of the dog wagging the tail, right?
Right.
The short end of the curve control it, or the long end of the curve following the short, right?
Exactly. So a lot of people that are running around saying that there's going to be inflation, they're looking at the tail, the end of the curve. right? And we've all seen that dog, that gets real excited and it wags its tail so much, its rear end, cycles back and forth, but still when it does its running somehow, it still goes where the nose is pointing. So if you want to know if there's inflation coming, you need to look at T-bill yields, you need to look at 2 and 3 year treasury notes, because that's what really tells you when the front end of the curve is rising, okay, panic. And people have asked, Steve, what would it take for you to admit you're wrong? Because everyone's looking at the long end of the back end of the curve. Tell me when 2 year treasury yields rise. When that starts to rise, we're like, all right, you know what? We got a problem here. And they're not budging. In fact, they're sitting at 0.111%, I think, as the time we're recording. You break 0.1%, and you got a major problem, because guess what also is being heavily shorted right now, Tom? The front end of the curve. 2 year shorter term short positions. So people say it can't go negative. Well, you're right. The Treasury cannot issue negative yielding bonds. They can issue at 0. Doesn't mean the curve can't go negative. So can you imagine tomorrow if we woke up and this thing broke overnight, if 2 year yields broke overnight, caused a massive short squeeze in the futures market, and we woke up and yields on 2 years were negative tomorrow morning? Do you want to see what massive risk off is going to be? And we're that close. I mean, we're just so close to this. So yeah, I focus on the front end of the curve, even though from an investment standpoint, I want to be at the long end, because that's where you get your biggest play on duration. So if you're confident in where the interest rates are going, you play the long end of the curve.
So we kind of say all this. I appreciate that you can explain all these complex, bonds and T-bills and all these different pieces of the puzzle to our audience. But you also talk a lot about lateral shifts that you can make, let's say from bonds to gold miners to keep capital. So can you give us a couple examples of these shifts that you would make, Steve?
Well, yeah, I mean, so I kind of always started to show off, what if I'm wrong? That's always the issue. And as a money manager, every day, that is, I like to say I try to poke holes in my thesis. What is interesting is a lot of other people try to poke them for me, and I kindly and gently remind them of, I've been poking holes in this thing so long that I think I found all of them. But so okay, so what if I'm wrong and there's going to be a reflation event or a really high inflation, which is possible. I think the probabilities of that are super low, but let's just say it does play out that way. Well, we still look at the structure of GDX and say, okay, it's likely to make a move lower. There's likely to eventually be another correction in the market. I mean, they don't go up perpetually, as we all know. And when that happens, usually bond prices rise. And in fact, even when you look closer at, if you really look at the long bond in particular, and you say, okay, the sell from August, maybe that's just the terminal event. And you go back in history and you see, it usually doesn't work that way. Usually if there is a big sell-off, and generally it's sharper. I mean, when the bond markets are shifting, it's like walking off a cliff. I mean, it's just straight down. So there's usually going to be a counter trend rally. Equity markets usually correct, and gold miners at this point are projecting a drop down. And let's just say they just drop down to, maybe the low 20s. Maybe they get down to 16 to 17. So I don't sell my bonds at the all-time high. I take a cut off of the peak. I sell them, I laterally shift over into the miners, and then I ride. Well, we all agree, it is an inflation sensitive asset class that does really well, when there's money printing, all that stuff is gold. And if you like gold, then we all know miners are just a leverage play on that. So I just laterally shift over and I still come out ahead.
Perfect. You also talk a lot about GDX being a proxy for liquidity. So what is its relationship between it and equities?
Well, to me, it leads it. And that's what I look at. So it leads major events down, and it leads major events up. Now, in between that, so someone might say, well, it doesn't, if that's the case, then you would see GDX always, maybe outperforming the S&P 500 or running along with it. And it doesn't work. I think we all wish that way, right? I mean, all of us, I think, listening to the show are generally bullish on the miners at some point or invested in them some point. That'd be great, right? Then we can just buy one thing and sit on it for a long, long time. It's not how it works. You look at GDX, it leads the market lower under major events. So the great financial crisis, you can just go back in time. And major moves down are led usually by GDX. And then bottoms of markets are led by GDX too. So, to me, that's just kind of what I like to look at, 2 year treasury yields, look at GDX. If I see GDX going down and the broad equity market going up, I'm like, okay, the broad equity market isn't going to last. And then if I see TLT, in this case, or long bonds prices start to rise as GDX falling, I'm like, okay, now I've got a major event here. And then all I've got to do is just time one and go to the other. And the great thing for someone listening who says, okay, I don't know if I believe you. Cool. Don't. Go pull a chart, run GDX versus TLT, go back to, like October 08, you'll see the flip, and you'll see that if you would have sold TLT near its top, presuming you could have, and go look at where GDX was pretty much right at that time. And then what did GDX do? It led the broad equity market up. So yeah, I like to look at it as a proxy of liquidity, and it works really well for that.
Interesting, Steve. So yeah, that's, I think, a great way to kind of wrap up how you're seeing this relationship. Not that you're necessarily hating on GDX or gold, but it's simply a relationship that you have identified and seems to be, fairly repeatable, right?
Yeah, it's one of those things where I am long-term bullish on gold and miners. In fact, I often like to say is when I am no longer the self-anointed bond king and I go running out the back, I'm going to pillage a new kingdom. Well, I'm going to become the king of that, of miners or whatever name I come up with at the time, because that's where you want to be at major bottom position. You can go back and look at, in fact, just go look at March of last year. You saw the flip. And once you understand that relationship, then you know exactly what to look for. And so, if I look at, positioning, the reason I told people last time I was on your show is, hey, look, even if you're really bullish the mining stock, you could hedge a little bit with bonds. And it was because of that relationship. Now they've both gone down, but bonds haven't gone down that much. And if I'm right, and let's just pretend I'm only partially right. GDX goes down to 16, which, I know it's still not a popular view, but a lot of people would want to buy there. Well, you just simply take your bond profits and you buy more at the low, so you offset some of those losses you incurred. And that's just called smart investing. Is if you're going to be all in something, which I'm an all-in type of guy, because I do a lot of my own, I do a lot of research. I don't subscribe to hardly any, research publications. I do all my own research. And when you have a very high conviction and you understand how the system works, then you can make the bet, right? Tom, if you and I were to go to Vegas and play roulette, which is obviously one of the risky things to do, is put all your money on one number. But if you knew that the probability of that number hitting was so high, you would put a lot of money on it. Mm-hmm. That's when you have a really high conviction about how the system works and how things play out. You can do that. The problem with going all in on, say, something like gold mine stocks is because they can just move so much. I mean, we've all been there. I've invested in them. I know, look, when they go down, they can go down a lot in one day. You better be highly convicted about it, or you better have a really low entry point. Mm-hmm. And so just looking at what I'm seeing play out, that if I am right, and I don't want to be right for all the people that are in it, but you have to just look at the big picture. There's a technical picture of a head and shoulders top and bottom. It's riding this 50-day moving average down. It's telling us there's a liquidity issue. It's falling TLT, and if TLT starts to rise and it keeps going, it's telling us major risk off event. You got to hedge yourself. And if not, well, I don't know what to tell people to do, but I do know how I'm going to end up playing it is one shift over to the other, and then longer term you just switch out of gold mines. So you can't ride them forever because they just don't work that well for a long term. But you can get a few years, you go back to October of 08. Had you sold your bonds and bought GDX, do you know what it went up in the 2 years following, Tom?
I don't have that number off the top of my head, no.
Yeah, 300%. 300% in 2 years.
That would be a great point to invest.
For most investors, that would change their financial future. Mm-hmm. So I look at it this way. If I'm right, then I've got a generational opportunity to completely change, my family and my clients' financial future. Mm-hmm. If I'm wrong, I just haven't lost as much when GDX goes down and hits a better place to buy, and I could still make money. That's all it is.
Perfect. All right, Steve. Well, I think that's a great place to wrap up. Do you have anything else that you'd like to share with us before we conclude here?
No, I sure don't. But I really appreciate being on your show. And of course, if any of your fans want to find me, I've got a macro YouTube show that I do Mondays, Wednesdays, and Fridays. I don't know if you'll put a link on that for people, but they can definitely find more of my research there and maybe follow along to see if the bond king will eventually become the mining king.
Yeah, the mining king, or maybe you can even add some flair and be the bonanza king. I know there's a great book by that title.
Okay, yeah, I never know. Well, my wife's the prop master for the show, so it depends on what we can come up with that she can create.
Awesome. All right, Steve, thanks very much for your time today.
Thanks, Tom. It was a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.